So you may be asking yourself at this point, what am I going to use this for? I think that's a common question among students. So I'd like to also talk about the three finance career categories or career paths that you might choose if you choose to pursue a degree in business finance. The first is in capital markets and institutions, and these are working for mutual fund companies, insurance companies, service and investment banks. These are typically companies that are located in money centers, large urban areas around the world. We don't have too many of those, if any, even here in the state. We do have a few companies that are doing some of their back office work in Salt Lake and in Las Vegas, but many of these types of careers you'd have to move to one of the two coasts. We do, however, have quite a few people working in the financial and investment services here in the community. These are working for brokerage firms, full service banks, mutual fund companies, insurance companies, primarily in a sales position, and this also fits working for banks, commercial banks in lending, and your depository banks. The three main functions of these types of jobs would be sales, analysis of individual securities, and optimizing portfolio asset allocation. So if you have, you're planning for retirement, it's a good idea to solicit the assistance of a financial consultant to help you kind of plan for the future. What do I need to save? Where do I need to save it? In what kind of categories do I need to have my assets? And how can I best avoid future and current taxes? And these types of questions. Now, banking is probably the most visible area in finance because most of us probably have a bank that we use, but the most common and probably the most people that are employed are in some form of financial management. Now, this is working for any company. Even from the smallest company, you have to have a financial manager. And that financial manager decides how to finance the firm, or how to figure out how to come up with the funds needed to buy the assets for either improvement or expansion or even begin opening. They need to decide how much debt to issue, how much equity to issue, how much of the earnings they need to retain or they need to pay out as a dividend. Ultimately, their job is to minimize the costs of financing, finding the least costly way to finance the assets. Now, the least costly way commonly is the way to minimize the risk to the cash flows. So if I can minimize the risk to the cash flows, I can get the best possible terms. If you walk into a car dealership and want to buy a car, but you have a very poor credit rating, well, there's a high risk to those cash flows. So the costs of financing that automobile are going to be very high. It's the same with the business. When the business can reduce the risks in their cash flows, make them more certain, they can in turn make it easier and less costly to finance. So I have a graphic here that shows that I borrowed from another site, these three areas, and you can kind of see different avenues or different types of careers that fall within those three areas. And the area that we'll be focusing primarily in this class is this area of business finance and financial management. We teach a number of courses here at Dixie State that involve investments as well as financial institutions. So we have an Intro to Investments course, and this is Finance 3750. And then Financial Institutions is our Money Banking and Credit course, which is Finance 3200. But you can see there that this is kind of the three areas that they're split up. Now, some of those you might be familiar with, other ones not so much. Please feel free to ask, and we can talk about those different areas and what's available. All of those are available to you if you choose to pursue a degree in business and finance. Some of them might be more interesting than others. Okay, so a financial manager is hired by the owners of the company to run the business. The book says that the primary goal of the firm's management is to maximize shareholder wealth. Shareholder wealth comes from several sources, and sometimes it's temporary and sometimes it's long term. We need to change that idea a little bit because you can probably think of examples such as Enron and WorldCom that the managers have not always acted in the best interest of the shareholders. In other words, they have not maximized shareholder wealth. So we want to change that a little bit to say maximizing shareholder benefit. That word benefit implies that we're talking about long-term viability of the company, not just short-term gains. So maximizing stock price may not necessarily be beneficial. The term benefit is broader than wealth and implies an overall risk management. Now, do we have a better measure for stockholder benefit other than stock price? Not really. It's very difficult. And this is an area called agency costs. Now, I'd like to pull in a website here and show you how you can use different websites to research these different terms. And so I looked up agency costs here on Investopedia. Investopedia is a great website. I have a pocket dictionary, but Investopedia is really an online dictionary for any of these terms that you might want. So agency cost is a type of internal costs that arise from or must be paid to an agent acting on the behalf of a principal. Agency costs arise because of a core problem such as conflicts of interest between shareholders and management. Shareholders wish for management to run the company in a way that increases the shareholder value, but management may wish to grow the company in ways that maximize their personal power or wealth that may not be in the best interest of shareholders. You might think, well, I don't think that would happen. I'm telling you, it always happens. Anytime you separate ownership of an asset from management of an asset, you have an agency cost. Maybe you've experienced this. You've gone and got a rental vehicle and you've paid the full insurance coverage on it. At that point, you now have this separation of ownership because you know you're not liable for any damage that might occur to that. And so you've heard the term, it's a rental. Well, rental property tends to be treated poorly or less than if the asset were owned personally. So how can a manager maximize shareholder wealth? By minimizing the costs of financing. They can do this through this optimal mix of capital structure. They can purchase the right assets that have the highest return. This is called capital budgeting. And they can make prudent decisions about how to spend the company's resources. And this is called payout policy. How can we mitigate the problems that occur when you have agency costs? And agency costs always happen. Well, there's three primary ways. The first way is just pay. When we structure payment or compensation schemes that align the incentive of the manager to act in the best interest of the owner, then we can ensure or at least help make sure that that manager acts in the best interest of the owner. Compensation schemes might be in the form of stock. More commonly, that stock is paid out in what are called options. Options have value when the stock price goes up and do not have value when the stock price goes down. So it incentivizes the manager to increase the value of the stock. That's the incentive. Now how about the punishment? Well, there's two primary ways: governance and takeover threats. So every corporation has a board of directors, and the primary job of that board of directors is to govern or manage the managers of the company. So they set the incentives, they set the compensation, they decide when to fire. If they need to hire, they decide who to hire. Secondly, takeover threats. If the stock price falls to such a low threshold that another company sees this as a strong buy, they might come in and do what is called a hostile takeover. They attempt to buy the company's assets through the stock, and then once they buy that, they come in, fire the bad managers, and replace them with managers that can more efficiently use the assets. So through compensation, governance, and takeover threats, the agency costs can be mitigated but not eliminated. Okay, and then finally in this segment, we'll be talking about what is it that investors are after? What is it that managers are trying to provide? They're trying to provide one of two sources of income. The first is a positive cash flow. Typically, if it's a stock, it's a form of a dividend payment. Second, they want the value of the asset, the financial asset, to appreciate. So this is what is called capital gains. So flows from a corporation come in the form of dividends or capital gains. Now the timing is critical. Cash received sooner is better because you can use it to invest and make more. This is what is called opportunity cost, or the opportunity cost of capital. So if I can get $1 today as opposed to $1 tomorrow, I can then invest that dollar today. So investors are typically risk averse, so they prefer their money earlier rather than later. Given two securities that are equally priced but with different degrees of risk, the rational investor would choose the one with the lower risk. All else being equal, a security whose cash flows are more certain is more valuable than a security with a relatively less certainty of those cash flows. So let's think about the following experiment. Let's assume that I flip a fair coin, quarter. I know that there's a 50% chance it'll land on heads and a 50% chance it'll land on tails. And I tell you that it's going to cost you $100 to play. If you get a head, you get $200. If you get a tail, you get nothing. Well, this is what is called an actuarially fair game, because half the time it will show up heads, half the time it will show up tails. If we play this multiple times, all the wins will offset the losses, and so there would be basically no profit or no return. However, if we only played this one time, there is a significant risk, a 50% chance, that you'll lose your money. Will you play the game? No. What if I were to lower that cost so that it only costs you $10 to play? Now the returns become much greater, because the expected payout is equal to the probability times the outcome. There's actually a $100 expected payout on this game. Would I pay $10 for the chance of, on average, getting $100? Yes. So when the price comes down, even though the risks have not changed, the investment becomes more attractive. We see this relationship between price and risk. So when the risks go up, the price must come down to compensate for that increased risks. And when the price comes down, the returns go up. We're going to readdress this in great detail towards the